Hi everyone, welcome to the third finance class. We're going to be reviewing what we learned in lesson 1 and lesson 2. I made this PowerPoint, and there's a link in the description box of the first two lessons to a Google Drive where a lot of these files are available. So you can open up these Excel files yourself. There's a PowerPoint file that I kind of teach from as well. So without any further ado, let's kind of get into it. In lesson 1, as you recall, we talked about kind of an approach to finance and how to learn about finance. And then in lesson 2, we got into start to look at some asset classes. We're going to look at some other asset classes today. We're going to focus in general throughout this course on equities, public equity, private equity, but we're going to look at debt or credit, as some people like to say it lately. We're going to look at both of those. It's one asset class, debt, and we're going to do a little of that today. And then, so in terms of spreadsheets, I would just have an open Excel file if I were you. That would be my approach. And then with respect to the YouTube link, you can just follow along on there. Okay, so let's review equities. We spent some time talking about the holy trinity of financial statements: the income statement, the balance sheet, and the cash flow statement. Someone actually made me a GIF of a holy trinity of me as Jesus and saying, and having the financial statements out there. So I thought that was pretty funny. And if you want to link that GIF, I'd love to see it again. It was pretty funny. We spent some time on the income statement, the balance sheet the other day, and the cash flow statement we're kind of going to save for probably lesson 7 or 8. It's a little more complex. I'm going to ask Base Chica to help me moderate this chat while I'm not paying attention to every chat. So anyway, we talked about the kind of 6 things that I look at: stock price, shares outstanding, market cap, net cash, and enterprise value. Net cash is just cash minus debt. That makes 6 things more or less, 5 or 6 depending on how you look at it. And that's the 6 things I look at. First 6 things I look at for any company whatsoever.
Martin, do these guys know how the statements are all tied to each other?
Yeah, we're going to go through that. So, definitely. So, next we sort of reviewed in lesson 2 accounting. So accounting is the language of business, and it's really, really important. Without accounting, we can't really do finance. So it's pretty critical to understanding what we're going to do. And we don't have to learn too much about accounting. You can take an accounting class and learn T-journals and all that stuff. But I don't think it's necessary. I think we can get through most of this with a rudimentary understanding of accounting. So we spent some time on GAAP and balance sheet and stuff like that. GAAP and FASB and some of those rules. There's some more notes in the PowerPoint on accounting as well. How to expenses and non-cash expenses and things like that. Talk a little bit about non-GAAP accounting and how it can be useful sometimes. We spent some time on the balance sheet. We spent some time on the income statement, and we're going to continue to do that. I just repeat myself briefly. If you don't like it, you can leave. That's fine. And so we then sort of ended the lesson with, on slide 13 here, which is the value of a company in theory. And we started exploring what discounting cash flows looks like. And I think that we did it pretty quickly, and we're going to do it a little more slowly and carefully now, just so we can really grasp it. But one thing that I wanted to sort of put this idea in your head that's really important, and I put it in blue here on the PowerPoint, and it says that a company is worth the discounted sum of its cash flows from today until eternity. I thought that was pretty interesting if you think about what that means. A company is worth the discounted sum of its cash flows from today until eternity. And I think that's a pretty complete definition of how to value a company. It's not perfect without having an extremely long conversation about it. but it's close. And I think it's an important concept to keep in mind. A company isn't worth its cash flow today or tomorrow. A company is worth its cash flow from today and forever, until forever. And the job of an investor is to calculate those cash flows, to forecast those cash flows. That's kind of the first half of it. Forecasting those cash flows and then assessing the risk to those cash flows is the job of an investor. In fact, you could basically distill investing to that. It's forecasting cash flow and assessing the risk to those cash flows, calculating a value, and then trying to acquire those assets for less than that value, or to sell those assets for more than that value. That is, in essence, what investing in finance really is. So at the end of the day, we're going to spend a lot of time, probably the next year, thinking about how to do that. Now, how much do we discount cash flows by? Well, it's certainly related to the risk to those cash flows. At the end of the day, if we can count on those cash flows as very likely to be received, we don't have to discount by very much. But as we know, there's always some amount we have to discount by. There's inflation. There's always some risk to cash flows. Even if they're the U.S. government backstopping those cash flows, there's definitely risk to all cash flows, and inflation risk and alternative rate of return risk. All of these things we briefly touched on and talked about last time, and I think that we're going to talk about them even further. So one of the things that I wanted to do, because I think it would help quite a bit in sort of understanding this point, is we're going to look at something called a bond. Now, you undoubtedly have heard of stocks and bonds, right? But you probably haven't really had a lot of experience with bonds. A lot of people have experience with stocks because it's easy to trade stocks. You can go online and trade stocks, and you can go online and trade bonds, but a lot of people don't. I'd say 95% of people have traded stocks and not bonds. And when people do get bonds, they typically don't trade them. And I think that that's a mistake. In fact, anyone that works for me, I sort of demand that they look at bonds and other asset classes, because they don't get a complete understanding of stocks and equities, and private equity especially, unless they've experienced some other asset classes. So what is a bond? Well, a bond is a debt, a loan, a note, any kind of instrument like that. It's a contract where a lender advances to a borrower funds. The lender gives the borrower funds, millions of dollars usually, and expects to be paid back with interest. It's a loan. It's a debt. That's what a bond is. Now the details and the terms is what we call the terms of that loan are very important. We've got a couple of key things. The first is the principal, and that's the amount that we borrow, the principal. The next is the coupon, which is the interest payment. Now the interest payment can be calculated in all kinds of ways. It can be paid annually, biannually, quarterly, and it depends on the principal amount. Is the coupon fixed coupon? Is it based on the current principal? And that relates to something called the payback period or the maturity. That's the date that the amounts which were borrowed are due. And are there paybacks only at the maturity? In other words, a balloon payment? Or are there prepayments at any time? Is there a fixed payment schedule every year? There's tons of different ways to think about how that works. And we're not going to go through yield to maturity and all those things. This is not a bond class necessarily. We might do that later. What I wanted to do was to try to discount a basic bond. And so the way we're going to do that is we're going to go to Excel, and we're going to pretend this is IBM. We're going to pretend IBM wanted to borrow, for whatever reason, a very small amount of money. Let's say they wanted to borrow $5 million. I think IBM would ever want to borrow that small amount of money. In fact, we can see on Bloomberg how big IBM's outstanding bonds are. They have bonds as big as 3 or 4 billion. The smallest bond they have that I can see right here is $750 million. So borrowing $5 million isn't something IBM is going to do. Here's a $600 million bond of IBM's. So all right, so $5 million. They're looking to borrow $5 million. They're going to get the money on 1/1/17, and they're going to pay it back. Let's say it's a 10-year bond. They're going to pay it back on 1/1/2027. So they borrow it on January 1st, 2017, and they're going to pay it back on January 1st, 2027. And let's say the coupon, so here's the principal, is $5 million. Let's say the coupon is 5%. IBM tends to be able to borrow for less than that, but let's say for argument's sake, IBM said, you know what, we want to borrow this money 5%, $5 million. So now what we're going to do is we're going to make a calendar, in essence, 2017, and we're going to make it out to 2027. And in essence, we're going to make two things. We're going to write amount outstanding, or principal outstanding. Is it principal with PLE or AL? I think it's principal
LE.
with LE, right?
LE. Yeah.
Yeah, I'm almost certain of that. Let's triple check. I've never traded bonds for a living or anything. I've sort of done it on the side. Anyway. Yeah, I would think
Martin,
it's...
how big is the bond market compared to the equity market?
It's a great question. The bond market's bigger than the equity market.
That's what I thought. A lot bigger, right? Because
Yeah,
of
it is. It is, yeah, and that's mostly because of sovereign debt and stuff like that. But so the amount outstanding pretty much at all times, bond principal is definitely LE. Yeah, certainly the principles of finance, that principle is LE. But I was wondering if principles and bond principal could be potentially PAL. Anyway, the principal amount outstanding will be $5 million for the entire amount. They're never going to prepay this coupon. This debt terms equal no prepayment allowed. They can never retire this debt. They can only retire it in 2027. So the interest payments every year will be what? 5% of $5 million, which is $250,000. But in year 2027, interestingly, in year 2027, they also have to pay back what? They have to pay back the $5 million because they borrowed the $5 million, right? So they borrowed the $5 million. So last year they're going to pay back the $5 million. The payback amount will be zero until the last year, where it'll be $5 million. So, in essence, there is a cash flow. You don't think of bonds as producing cash flow. They produce kind of repayments. But from an equity perspective, they kind of are giving us back cash, right? And in the last year, they give us back a ton of cash. And we can sort of discount that, can't we? We can use a discount rate. And let's say that discount rate is 3%. We think that the risk of IBM defaulting or otherwise ruining our money through inflation or other ways is 3%. So if we take the net present value, in Excel we do equals NPV, parentheses, we take the discount rate, we press comma, and we take the series of cash flows, close the parentheses and hit enter. And we can value the bond at $6 million. So in essence, this is a very attractive bond. This is a very attractive bond. We will get 10 payments of $250,000. We'll get a last balloon payment of $5 million. It's a 5% coupon bond, if that makes sense. So the total value we get is $5,744,657. And
Martin,
of course,
how'd you get to 3%?
yeah, it's a good question. So obviously, we wouldn't lend IBM money for 5%, right? If we felt that the risk to those cash flows was more than 5%, or we'd in essence be losing money. So if we put it at 4%, what ends up happening is that NPV is closer to the $5 million. If the NPV of issuing this bond is $5.3 million, and the cost to issue the bond is $5 million, so let's take that, the net NPV. By lending this money to IBM, we make $275,000 in essence. If it was 5%, we break even, or we lose money. We lose money. If it was 7%, we lose a lot of money. It's riskier for us to lend IBM our money if we think the discount rate is 7% than it is to just hold our money and not lend it out. So we have to think about what is the risk. IBM is a very established company. It's probably going to be able to pay us back. But there's some people that think IBM is going down the tubes and won't be able to pay us back. So you have to decide for yourself as an investor, what is the discount rate? because you're a senior secured lender, typically bonds are senior to equity. It's very important. Typically, bonds are senior to equity, which means that if something goes wrong with a company, the bondholders get paid first. They get cashed out first. And if you're senior in the capital structure, is what we call it, especially at a big company like IBM, it's more likely than not you should be able to recoup your $5 million.
Okay, so Martin, when we're discounting equity, we use, you unlever and relever according to what the balance sheet looks like for that company. Do you do the same thing for a bond? Do you attach some sort of risk, risk-rated discount rate to the bond? Okay.
Yeah, of course. Yeah. So everything is up for grabs when you're analyzing the risk to a bond. If the company has a lot of other debt, then you may say, well, they're unlikely to pay me back. But for simplicity's sake, this is an introduction class. We don't want to scare anyone with fancy terms like leverage. We're just trying to understand that this cash flow, in essence, is repayment from the company we're lending to. And that, in this example at least, it's very unlikely that IBM is going to default. The discount rate is like 2 or 3%. It's close to risk-free. So by lending them money at 5% and perceiving the risk, this isn't the discount rate's sort of theoretical. It's very theoretical. We're perceiving that the risk that IBM doesn't pay us back is 3%. But what does that mean? How could that be so theoretical? It doesn't make a lot of sense necessarily. Well, we did this one other time where we kind of looked through other discount rates. We monitored other discount rates in the world to sort of get a sense for what other discount rates are. So we know that the U.S. Treasury bond yields, let's take a look. The 10-year Treasury bond right now is yielding 1.834% according to Bloomberg. 1.834%. Now we can check out what Apple's bonds are yielding. Let's look at a 10-year Apple bond. Apple Computer, the iPhone maker. Let's see how their bonds are doing. Looks like they're yielding 2.9%, 2.904%. How about Brazilian bonds? A Brazilian 10-year bond. I wonder what that would be yielding. The 2026 bond. Looks like about 6%, 5.965%. And then I joked that we have a friend named Charlie where I gave him a personal loan and his interest rate that I would charge him was 10%. And then finally, Bob the crackhead, my local crackhead, who I lend money to for 50% because it's so unlikely that he's going to pay me back that I have to charge such a high interest rate. Whereas for the US government and Apple, these are so credit-worthy institutions that we can only demand, all we have to demand is 2%. They're so risk-free that it's okay to only get 2%. It's okay that we don't mind that. That because if we didn't offer them 2%, someone else would. So there's a marketplace. And Brazil is borrowing money at 6%. They would love to borrow money at 2 or 3%. But Brazil is not even as creditworthy as a major company like Apple or Johnson & Johnson. That's how much trouble Brazil is in. So anyway, this is a good background for kind of how we discount cash flows. So if we turn our attention back to Apple, which we were building a model for, and again, this link to this file is in the description box of a few of the other lessons. And if you don't have the link to the description box, it's a good thing to have. How do we do this? Okay. I don't know if I want this big. This isn't helping. All right. So let's see. So we're going to open up the SEC website, which is where we get our financial information from. I'm going to type in Apple stock ticker, AAPL. And we're going to go to the 10Q before last. We just did this 10Q, which is the first quarter, I guess. This was the first quarter. And their first quarter is a different fiscal year. It's a little confusing. So this is the December 26, 2015 quarter, which they call Q1 16. It's a little complicated. All right, so let's pop in some of the financials from the last quarter. Let's go to here. I'm going to go to their press release instead of their SEC filing, and I'll show you why I did that a little later. So the good thing about Excel is you can copy and paste a row of data and formulas, and all the formulas will be preserved. So you just have to change the hard-coded data, and it makes it a lot easier to make a model. What we're doing here is called building a model for Apple. And I will save this, of course, as I always do, to the share drive. So, again, copying and pasting everything makes it very easy to get all of this data in very quickly. And practice makes perfect. You may think that I can do this very quickly, but it actually is a very normal and mundane speed relative to doing this for your whole life. You will become very adept at this. So you can see that in Q4, the September quarter, 926 for 15, so it's 927. Okay, you can see that Apple generated $51 billion of revenue in Q4, and then $76 billion in Q1. Remember, these are their fiscal quarters. Their calendar quarters are really like the Q4. So they have a big Christmas every year, I'm guessing. They have a huge Christmas season, a fall season, holiday season. And you can see that, and we call that in business, we call that seasonality. Seasonality. When you have one quarter that's usually the biggest quarter. I don't know, for most businesses, that's Q4, calendar Q4. Could be fiscal Q whatever, but it's certainly the calendar quarter. We'll fill in the balance sheet later. Let's go do another quarter real quick. Here's their third quarter, it looks like. And this time I'm going to the 10Q. I don't like to go to the 10Ks for a specific reason. They're very large, so finding the data takes a little bit of time, and then usually you have to do this kind of subtraction because they only give you the annual data. So for the last quarter of the year, I typically like to go to the press release. We'll talk about press releases in a second. All right, so there's their Q3, which is the calendar June quarter for these guys. Here's their, and here's the last year, 6/28/14, where they did 37 billion. So it's pretty amazing. They're doing 37 billion 6 or 7 quarters ago, and they did 75 billion last quarter. Unbelievable. I'm not used to numbers that big. It's crazy. One quarter, 75 billion of revenue. It's a lot of phones. Okay, and you can see their gross margins always stay around 40%. That means for every dollar of these phones and the iPads and the iTunes, everything they sell, the Beats headphones, I think they sell those, it costs them about 40 cents to make those goods. And they keep about 60 cents. And then, of course, they have to spend it on the other things, like their headquarters and their executives and their marketing and research and development. But at the end of the day, they're keeping about 28 cents, 28 to 30 cents in their business. And then after they pay taxes and all these things, they're at the final net margin, the net profit, they keep about a quarter, 20 to 25 cents. So you can see in this Q3 they generated $37 billion of revenue and ended up with $7.7 billion of profit. Okay, we have one last quarter to go, and then we're done with at least 2 years of data, and I'll show you what we're going to do with that. It's going to be fun. Here's their Q2, which is a little backwards. It's a 328.15. You can, again, copy paste all this stuff. And like magic, it's just very easy in Excel to just hard code the data we need to hard code. Some people like to color code everything, and I'm not a big fan of that. I don't think you should do too much coloring or too much bolding. I don't typically bold most of this stuff. It's not really helpful to do so. I've seen Excel models that look like rainbows. They spend more time on their color coding than they do on the data. I don't like that. All right. All done here. All right, so now we've got, let's make this a little bigger. Let me get my ugly face in here somewhere. Maybe up here. Oops. This might be frustrating. Hang on. There we go. All right. So now we've got, let's see. We've got 8 quarters of data for Apple. That was easy. We did that in what, like 5 minutes? Super easy. Well, now we're going to do the fiscal years here. So fiscal year 15 is the year that ends. It's the year that ends in 9/26/15. So Apple has this wonderful policy of having these kind of offbeat fiscal years, like the government's fiscal year, right? It ends in the different period. So the way we're going to tally these is going to be kind of interesting. We'll do equals sum, and we can see that Apple generated $233 billion of revenue. $233 billion of revenue in fiscal 15. We can still use some of the same formulas, but a lot of this is going to be equal sum. Of course, operating expenses are just all the operating expense lines summed. Operating profit is gross profit minus operating expenses. And then we're going to just sum things like interest and taxes. Pre-tax income is operating income plus or minus, depending if it's positive or negative interest income. And of course, net income is just pre-tax income minus taxes. For shares, we're not going to sum it. It's an average concept. Remember, shares outstanding is just the amount of slices of the company that have been divided up. In this case, Apple's, you can see that their amount's been going down. It was 6.1 billion, now it's 5.6 billion, and that's because they're buying back their own stock. So they're taking away some of those slices. We'll talk about why they would be doing that later. You can see that they earn about $9 a share in earnings. I don't really care too much for per share measures, but we'll talk about per share measures someday. They're very popular in Wall Street. All right, we need one more quarter to get the fiscal 14 numbers. I actually do want to get that. But I don't want to sift through this 10K. I guess I won't have to. Wait a second. I would. Would I? Let's see. I wonder when they changed their fiscal year. It's unusual. Here's 12, 27, 14. There's 12, 28, 13. So I can just do this real quick. And as I'm doing this, I'm sort of checking to make sure the numbers add up. 13,072 is 13,072, and this is all formulaic. So I can check as I'm doing it to make sure I'm not making any typos. And here's the other fascinating thing about Apple. You can see whenever you're checking growth, right? Whenever you're checking growth, you're looking at this year's versus last year's. So it's this year, you can see in blue, K3, divided by the red one, G3, minus 1, and in Excel we express that as a percentage. And it's 30%. 30% growth is a lot of growth. Most companies dream of 30% growth. It's very hard to get 30% growth, especially when you're a big company. You're hoping it for 5% growth. 10% growth is a miracle. 30% growth is insane. Why is it insane? Because it's hard when you have $50 billion of revenue per quarter. It's really tough to grow revenue that much. But of course, when you're Apple, you defy logic. And then you can see in Q2 they grew again. Q3 they grew again. Q4 they grew again. What? What happened here? Oh my God, only 2% growth. Is Apple coming to an end? Is their era, is their reign coming to an end? Maybe. That was a surprise for Wall Street. 2%. 2%. What happened? Why are sales slowing down? Well, we'll talk about that later. Who knows, right? Who knows? So how do we, let's add up the 2014 sales, and then we're going to worry about the future. The past is interesting, but the future is more important. So I'm going to copy and paste just the formulas here. Just the formulas. And then here I'm going to copy and paste the summed formula. And here I'm going to do the average for 2014. Done. All right. Now you can see year over year, revenue in general grew about probably 30% is my guess. 28%, good. I'm going to copy and paste this going forward. I'm going to extend this out another, say, 15 years or so. Our model is taking shape very nicely, if I do say so myself. All right, so what about 2016? Is Apple's growth, has it come to an end? Nobody knows. You don't know, I don't know, even Tim Cook doesn't know. Of course, Tim Cook probably doesn't think it'll ever come to an end, but I remember when companies like Motorola and Nokia thought their growth would never come to an end. And usually, when you turn into negative growth, first you have to go from high growth to no growth, then to negative growth. So I'm going to do my best to forecast. I'm going to forecast this Q2 2016 number. Well, how do I do that? Well, last year they did $58 billion in revenue. So what do you guys think they'll do this quarter? Give me a number. What do you think? $58 billion last quarter. What are they going to do this quarter? What do you guys think? 65 billion, 30 billion, 45. You guys are crazy. You guys are crazy. No, we don't have to do a linear regression model. I don't think that's going to be helpful. 90 billion, 10 billion, you're all nuts. You're all nuts. The iPad Pencil coming out, is that going to help? Well, it certainly may be a little bit related to product launches, but a basic forecast we can do is we can take last year's number and we can multiply it by a growth number. So if we were going to say that it was going to grow by 5%, we multiply by 1.05, and we get 61 billion. And Apple has not shrunk in a long time, is my understanding. Let's take a look at that. And I want to point out that the goal isn't to accurately forecast the revenue number perfectly, and I'll explain why. So you can see Apple has not shrunk in many, 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 many years. Since 2006, and we don't even have data that goes back further than that, 10 years, they've not had one quarter. Where revenue was lower for that quarter than the year before. For this quarter, you can see that Wall Street is expecting 52 billion in revenue. So not only does Wall Street think it'll be the first quarter in a long time where Apple actually generates less revenue than before. We don't know, Wall Street could be wrong. It could be 56 billion, 58 billion, but certainly Apple's saying something. We'll see what Apple's saying in a minute, but Wall Street thinks it'll be lower than last year for the first time in over 10 years. Crazy. That's so crazy. How about the next quarter after that? They're saying -4, then +1. Well, what if there's a recession? Then that'll affect these numbers too, right? It's hard to say. Let's assume something in the middle. Let's assume it's not as bad as Wall Street thinks, but I also think Wall Street's estimate of a quick recovery is probably too ambitious as well. So, but I don't really know. I'm not a close Apple watcher. I will be after this, as will you. But let's assume that. Okay, let's assume that revenue. Now, how about gross margin? They've been pretty steady at 40%. So unless their costs are changing for their products, I'm going to keep it. At 40%. And COGS are just the subtraction of those two. How about R&D and SG&A? Well, for Apple, these numbers don't matter that much. They're so small relative to the rest of the business. So I'm just going to take last year's number. I'm going to take last year's number. Whatever they did last year, I assume they'll do that this year. The rest are all just formulas. Interest expense, interest income. Well, they keep making more and more money on their interest because they keep hoarding all their cash. How about taxes? Well, let's see. Their tax rate has been pretty consistent at 25, 26%. So I'll just do 25%. 25%. And now you've got a full forecast for the rest of the year. Now, it's not the most advanced forecast, I admit, but it's a forecast. It means something. And now we can put down an annual forecast. And you'll see the magic start to happen here. Well, first, we can take the sum of, let's do 2016 real quick. Real quick. All right, so we have them declining by 2% in 2016. Now the question is, what is the long-term growth rate of Apple going to be? This is the trillion-dollar question, quite literally. Will Apple grow their revenue? Will they shrink? What will happen? What do you guys think? Shrink or grow? From here to 2030, shrink or grow? Take a guess. Shrink or grow? Static? That's a good one. Shrink? I think they'll shrink. Will the 2030 revenue number be above or below? Everyone's saying shrink. I think that's what Wall Street thinks. I mean, they have grown a lot. It's hard for them to keep growing. In my understanding of tech, they have reached the top, and most of these companies that reach the top tend to shrink again. Now, having said that, there have been companies like Microsoft and IBM that have sort of had these ups and downs. It's hard to tell. Some people think they might grow. Who knows? Certainly without Steve Jobs, it seems like they might need a miracle, a new product, and it can't cannibalize, right, the iPhone. So iPhone is most of their sales. So we'll see. Let's assume, for argument's sake, that it shrinks by just 1% a year. That's barely shrinking, right? That's barely shrinking. How about margins? We have to guess on their margins. Will they be able to make more money per phone or less money per phone? Well, costs tend to go down over time, but the features tend to go up as well. And if they do get into other businesses like cars and other things like that, who knows? I don't know that margins will go up that much. Remember, other costs go up too, like employment costs. And yep, you're right. It does depend on who's the president. Let's assume that margins are the same. Let's assume that they're the same. I think that's fair. How about their other costs, like research and development and SG&A? If their revenue is going to decline, should we assume their costs decline a little bit too? I think that's only fair. That's only fair. How about interest income? That'll probably keep growing because all the cash they're accumulating. Taxes, will their taxes go up? I don't know, it's hard to say. 25% taxes seems reasonable. So now we've got a long-term forecast for Apple that goes out to 2030. So what do we do with this forecast? What do we do with this forecast? Who gets a gold star? Who gets a gold star in class? How do we take this forecast and make it useful? Ah, we got a winner. We got one winner at least. Akil, of course. Got a few people who have the answer here. We have to discount back the cash flows. Exactly. We calculated all the cash flows. These are the cash flows. Cash flow and net income are more or less the same thing. More or less the same thing, especially in a business like this. So we're going to discount the cash flow. But before we do that, we actually have to do, well, let's try this out. Let's try it out. What discount rate do we use? We know that Apple borrows money for 3%. But equity is junior. Equity is junior to debt. So they're paying 3% for the debt. It has to be more than 3% because the debt is less risky always than the equity by definition. So it's got to be a little more than 3%. How about 4? 4%? 5%? 5% sound good? Most equities right now have a discount rate of about 7%. Yeah, it is intro to finance. That's what we're doing. Yep, Finance 101, correct. So I think a little better because we're jumping into investing. All right, so 5%. Let's do 5%. And so if we take this NPV, what do we get? We get $500 billion. That's the value of these cash flows. But remember, the company has net cash. How much net cash does the company have? Well, we have that on the first page. They actually have a bunch of stockpiled cash, and you get that too. That's $160 billion. So the total value is $666 billion. And per share, how many shares do they have? 5 billion. So per share is $120, and the current price is $97. So our calculator is telling us that the shares are worth $120 and the current shares are worth $97, but there's a huge error in this model. What is that error? What is that error for someone who's the expert? What is the error? What is the error? There's a gigantic error in this model. Who can spot it? Who can spot it? Nah. It's a much more fundamental, basic error here. Yes, Brett Larson's got it. No. See if any of the Blab users can get it. I like turtles. Yes, the terminal value. The terminal value is crucial. So remember what the definition. The definition. A company is worth the discounted sum of its cash flows from today until eternity. This model ended in 2030. I don't know about you guys, but I hope to be here after 2030, and I'm sure Apple feels the same way. So I think that ending the company in 2030, that doesn't make sense, right? They're going to be here in 2040 and 2050 and 2060, right? So we got to keep this going. But how do we keep it going? The maturity value, let's say they'll shrink by 2% a year. 2% a year. This is a pretty obvious error, and anyone who got it wrong should be ashamed of themselves. Just kidding, but remember for next time. And you'd be surprised how many advanced financial experts make simple mistakes like this. And they say, in fact, in pharmaceuticals, that's one of the ways that I made a lot of good investments was to say, well, people don't understand that for instance, patents run out. So in some drug companies, you've got until 2025 or 2030, and then it's over. All your cash flow goes away. In some businesses like Apple, it might last forever. We can't really predict what that forever looks like. So it's a good idea in general to make the maturity value decline every year after maturity. It's pretty unpredictable. It's a good idea to do that. It's a good idea to do that. It doesn't really matter how many years you go out. You go out 100 years. After enough discounting, it's not worth much anyway. So what we do is you take that NPV, we're going to extend it out. You can do this with the mouse or you could do it with the keyboard. I'll just do it for the mouse, just so for pizzazz. And you can see that the value of Apple's actually, according to us, about double. According to our model, it's about double. It's about double where the current stock is 97. And our model is telling us that the stock will be worth $176. $176. So we say terminal value, not term value usually. So why? So why is Apple trading at $97 if Our calculation took about an hour. Our calculation is telling us that it's worth double that. Why? Why would it trade for half of that? What do you guys think? Yeah, there's a few reasons. So one is that no, it's not enough buyers. No, it's look at the model. The model is telling you, the model is not wrong. If these things happen, this is a calculation that's as sure as gold. If this happens, it's worth $200, $175. It's because there could be more risk to these numbers than we think. We don't know if this will happen. This is forecasting Apple is going to be a leader in tech for the rest of eternity. That may not happen. That they're going to shrink just slightly. That may not happen. Apple may shrink faster than that. And the risk that we're saying that this will happen is very low. We're saying not only will they be a top player for the next 30 years, but it's very unlikely that anything bad will happen to them. Well, that seems a little generous, so maybe we bump that discount rate to 6%. All right, now it's not as attractive. The per share value is 157 instead of 175. Well, what if we increase that maturity value, decrease it to negative 3%? All right, that chops it down a little bit more. How about negative 4%? How about instead of a discount rate of 6, we say 6.5? Well, you can make this say whatever you want, right? So what value is it? Well, there is value. I'll show you in a second. But let's take that negative 1%. We have them declining by negative 1%. Let's make that negative 2%. What is the NPV now? Oh, it's only $130 per share instead of 97, which is the current stock price. Well, if you told me something is worth 130, and right now it's selling for 97, I'm not that attracted to that. That's only 30% difference. And most people are wrong, especially in stock picking. They're wrong by about 30%. And Christian, you're wrong about you're wrong about that. Net income does equal free cash flow over long periods of time. So I would argue that's a very trivial mistake relative to the terminal value, which is a huge mistake. So anyway, so the question really is, other than these sort of nits and gnats, the question really is, what will happen? How do we forecast accurately? Well, this is hard. You can't learn that in 5 minutes. I showed you in 15, 20, 30 minutes how to forecast the biggest company in the world relatively accurately. I mean, our model is telling us $130 a share. The current stock price is 97. And we can tell that if Apple starts to shrink, it'll be worth probably about where they're at. If they shrink a lot, let's see what happens if they shrink a ton. Let's see if the disaster ensues and Apple starts, I don't know if it's Facebook or Google, but someone just comes in and eats their lunch and just destroys them. What'll happen to Apple? Well, I could see their stock being worth $70. $70. What if they really get decimated? Like next year they drop by 20%. The year after that they drop by 20%. It really starts to get really ugly. Well, then maybe the stock's worth $45 a share. Things would really have to go bad for them. People would just not want to use iPhones anymore. They start to lose money here at some point. We're gonna correct that a little bit. They would put an end to some of their spending if they start to lose money, needless to say. So $60 looks like maybe the worst case scenario for Apple. $60 per share. That's if their business just gets chopped in half very quickly. And the current stock is 97, so $58 would be their kind of, I don't know if it's called a worst case scenario, but a pretty bad scenario for them. But easy come, easy go, right? Who knows? And so we're going to spend a lot of time talking and thinking about, how do we forecast more accurately? And that's a question that may not be easy to grasp, but it could take many, many years. So we're going to go to the softer side of business. We forecasted one company. We'll do some more. We'll do whatever company people want to do, Tesla or Chipotle or whatever company is fun that people would like. And we could build that model in as little as half an hour, an hour. But the hard part is learning a company really well takes a lot longer time than that. And let me go to the PowerPoint to discuss that a little bit more. So this is what we call, when we try to actually value a company, we have to do something called fundamental research. Fundamental research. And that concept is something that people on Wall Street spend a lot of time. They spend their whole day, buildings and buildings of people spend their whole day trying to do fundamental research. And what does that mean? Well, it's the type of research you do to forecast future cash flows. We sat here in Apple and we said, are they going to shrink? Are they going to grow? Are their margins going to go up and their margins going to go down? How much will they shrink by? How much will they grow by? All of these things are really important. And most importantly, what's the risk? What's the risk to those numbers? Is it very unlikely? Is it very likely? Is there absolutely no risk that we're going to have a downside downside expectation? And this is really tricky. So how do we do that? Well, the first thing that I wanted to point out is Phil Fisher's book, Common Stocks and Uncommon Profits. And I always keep a copy of it within kind of 10 feet of me because it's probably the best book ever written, I think, on this concept of fundamental research. It's not the best investing book ever, but it's a great book with respect to fundamental research. And the first few chapters kind of teach you how to research a company. And he coined a term that's not used very much anymore. It's an old word, but he coined a term called scuttlebutt. Scuttlebutt. This is how you spell scuttlebutt. And scuttlebutt is literally kind of, it sort of means the talk or the rumors about a company. And it meant that if you heard that the company had, a bad reputation, for instance, or that it was overzealous in how it sold products, or that it had a reputation for not paying people well, or whatever it is, scuttlebutt is kind of the talk, if you will. And you have to do quite a bit of that kind of research. And in modern times, in the old days, it was different ways to do it. Now with the internet, it's actually a lot easier to do quite a bit of that research yourself, which is kind of neat. So I would encourage you to read Phil Fisher's book, and we'll do that for Apple a little bit. I'll sort of read out a few pages of it, and then we'll sort of actually try to follow some of the guidelines in the book. And this is a book recommended by Warren Buffett and many others. Again, I wouldn't take it for gospel, but I specifically think those few chapters where they talked about, where he talks about how to research, do some fundamental research, I think are pretty good, or as good as I've seen. There's some other checklists and things out there that are also good, but after a while it becomes second nature. So what's the second way to do it? Well, management is part of Phil Fisher's approach, and I just pulled it out as a really important. Even if you don't read the Phil Fisher book, you have to get some kind of relationship going with management, whether you like management or you don't like management. So management of Apple is Tim Cook. Now how do we we're never going to meet Tim Cook, right? I mean, we're not friends with Tim Cook. We're not going to be friends with Tim Cook. We're not important enough as investors to be Tim Cook's buddy. But we can listen to conference calls. We can listen to Apple's conference call. Very few people do this. Even though it's very easy to do. You go to Apple's website, apple.com, go to the investor website, and here's their earnings call. You can actually just click and listen. And let's listen to a few minutes of it. And you can decide over time, I really like, it's nice and embarrassing, the streaming audio feed is currently unavailable. Come on, Apple, get your shit together. That's almost laughable that the earnings call is not up. Well, let me go to my fail-safe Bloomberg here, and let me see if I can get that conference call myself. I'm sure there's another link. If anyone could get the link, I'd be very happy. But for now, let me try to find it. Let's see what date their earnings call was. Isn't that annoying that it's down? Here it is. All right, so let's see what these. Typically, this video is not available. Why is this so difficult? Well, here's the transcript, but I want to listen to it. And here we go. Well, that's the Q3 earnings report.
Skip half your bill.
Break up with Sprint. Move to Metro.
Welcome to this Apple Incorporated third quarter
at least
fiscal
what it
year
sounds like.
2015 earnings release conference call. Today's call is being recorded. At
We don't
this
want the
time, for
transcript.
opening
We wanna
remarks
hear
and
what it sounds
introductions,
like.
I would like to turn the call over to Nancy Paxton, Senior Director of Investor Relations. Please go ahead, ma'am.
Thank you. Good afternoon, and thanks to everyone for joining us. Speaking first today is Apple CEO Tim Cook, and he'll be followed by CFO Luca Maestri. And after that, we'll open the call to questions from analysts.
So you can see here, you might not be able to talk to Tim Cook whenever you feel like it, but there's people that work at Apple that are investor relations people, and you could actually reach out to them. Reach out to Joan and Nancy. I mean, they're paid to talk to you. That's their job. That's their job, and you can see that they're on. They're on there, so you can email them and discuss it. Anyway, let's listen in a little more.
Please note that some of the information you'll hear during our discussion today will consist of forward-looking statements, including, without limitation, those regarding revenue, gross margin, operating expenses, other income and expense, taxes, and future business outlook. Actual results or trends could differ materially from our forecast. For more information, please refer to the risk factors discussed in Apple's Form 10-K for 2014.
So one of the things that I think makes a lot of sense to mention now is that when we think about these discount rates, let's open the model back up. Let's open this back up. When we think about these discount rates, we say, what discount rate do we want to use for Apple? And remember, we're going to have the same model, a similar model. We're going to have a similar model for Microsoft. We're going to have a similar model for IBM. We're going to have a similar model for Facebook, for LinkedIn, for all of its other industry competitors. And we're going to have to decide on discount rates for those companies. And how do we decide who gets the low discount rate? That's what you want as for an investor. You want, or at least that's what would make the value of the company higher. It doesn't necessarily mean that the company is a good investment. The only time the company is a good investment is if you can buy it for less than what it's worth. We have to objectively say which company is riskiest. And one of the ways we can do that is by judging management. We can judge people in investing. In fact, we have to. I don't like to be judgmental in anything else, but we have to judge management. And I don't think beta or volatility or anything, those are not good ways to judge management. It's intangible. It's intangible. You really have to make a gut check. So when we think about Apple's competitors or peers, we can think about what? Netflix, Google, Facebook, AT&T. What else? Who else? Let's see. We take RV and Bloomberg. We get a good guess. IBM, Samsung, Sony. Those are a few to name to name the least. Just big tech giants, big diversified. Apple's not that diversified, but tech giants. What are the discount rates we're going to give to all of these guys? Well, diversity is really important. Diversity is really important, and the type of business they're in. AT&T is a regulated monopoly, so it's going to have the lowest. It's going to have the lowest discount rate. Microsoft is very diversified, but it's not a monopoly that's enforced by the government. AT&T literally is a monopoly. Hewlett-Packard has struggled so much. So is IBM, but IBM is really diverse. Really diverse. Netflix is I think, probably the riskiest. Google is so entrenched and so seems to be not diverse, but they seem to be impregnable. Facebook has a short track record. I think it's pretty risky. Samsung, again, super diverse. That's kind of how I would put the discount rates. And part of that goes in discount rates is, well, how do I feel about the CEO of each company? Who do I trust? Who do I trust the most to make sure that in 2030 that this company is still generating a lot of cash flow? That in 2025, Tim Cook starts to think about a successor, or sooner than that, 2020. In 2022, Apple's new CEO I can trust and believe in. Who knows? Who knows? And that's why we have to think about management. The only way we can think about management, again, you're not at a company like Fidelity, where Fidelity will meet with Tim Cook. Fidelity will sit down with Tim Cook and grill him. They'll grill him. They'll say, let's see who else are Apple's biggest shareholders. Let's see who's Apple's biggest shareholder. Who decides their fate? Ken Griffin, maybe. Carl Icahn, right? Icahn is the 15th largest shareholder of Apple. And we know that Icahn calls Tim Cook all the time. Vanguard, BlackRock, State Street, and there's Fidelity number 4. These are usually passive mutual funds. Fidelity, there's some guy sitting there saying, do I want to buy Apple? Do I not want to buy Apple? And he's going to meet with Tim Cook and say, well, Tim, what are you doing about the cars? What are you doing about this? What are you doing about that? Why is iPhone sales slowing? And he's going to grill him, and he's going to do the same thing with all these other companies, and he's going to decide, well, I don't really trust the CEO of IBM. I'm going to give it a 10% discount rate. Or you know what? I really trust the Netflix CEO. I don't think I want to discount those cash flows by very much at all. And you can make these decisions as an executive. Now, again, you don't work at Fidelity, and even the people that work at Fidelity don't get to meet Tim Cook every day, or even once a quarter, perhaps, once a year. But nevertheless, you get to listen to the conference calls. And you may not get to meet Tim Cook, but you could get to meet some of the people that work there, whether it's in the investor relations department or perhaps just reading about them is just as good. So I think that getting a sense of management is quite important. The next step is something that I think is really important. I'll leave you with this. It's very, very important to read all of the press releases you can and update your model with them. Model isn't just financial. You want to be able to list things here, your notes, sort of all of your notes. iPhone, iPad, what are their other products? iTunes, any other products? How about potential future products? Is iCar in the pipeline? Is video games in their pipeline? Is reality TV in their pipeline? What's going to happen? What is Apple going to do? What are they going to do? Everyone watches their every move. And what's the breakdown? What's the breakdown? No, that's not right, Laura. It's don't spread misinformation in my chat. iPod. Oh, right, they sell computers, obviously. What is that? MacBook, stuff like that. Macs. And we want to do percentage of revenue. We want to take notes in our model. So one of the ways that we can do that is going through all of the press releases. All of the press releases. And as I mentioned, we can go to their website for that. You can in fact click press releases and hear all their press releases. And I expect you to go back at least 1 year. If you want to understand a company, you have to go back at least a year, reading every press release and listening to every conference call.
The Form 10-Q for the first 2 quarters of fiscal 2015, and the Form 8-K filed with the SEC today, along with the associated press release. Apple assumes no obligation to update any forward-looking statements or information which speak as of their respective dates. I'd now like to turn the call over to Tim for introductory remarks.
Thanks, Nancy. Good afternoon, everyone, and thank.
And if you read the press release, you can see that they're giving guidance. What's guidance? Well, Apple is telling you what they expect. They said for the second quarter, we expect revenue between 50 and 53 billion. So remember when all you guys were guessing? Well, Apple is guessing too. They said 50 to 53. And what are we putting in our model? We're putting 55. 55. Well, that's probably too ambitious. How about 54? And then they're saying gross margin will be between 39 and 39.5. Let's put in 39.25. And all of these will affect our numbers quite a bit. Here, we'll put it up here. 39.25. And you can see that the net income went from, hang on. The net income, when we make that change, went from 12.634 to 12.328. So it went down because of, needless to say, the margins are lower. So you can you get all this information. Expenses of 6 to 6.1. What did we have? Wow, we only had 5.3. Wow, so they're really going to be spending a lot of money. 6 to 6.1. So now we're down to 11 billion in net income from 12.5. All this stuff matters. What else can we do to do some fundamental analysis, some fundamental research?
Thanks for joining us. It's been a busy and exciting quarter, and I'm delighted to talk to you about the highlights. Today, we're proud to report record June quarter results with revenues of $49.6 billion.
Well, one of the things that I think is really important is to ignore other investors, to ignore Wall Street, and to ignore the television, like CNBC. I don't think you can gain much investing knowledge from any of these things. Other investors, you may mention that, hey, Martin, you have a slide full of other investors. Yes, I do. I think from legends you can learn something, but you're not going to learn something about Apple from these people. You're not going to learn something from other investors that aren't very successful. Even if you can talk to big hedge funds like Carl Icahn or Citadel or something, I don't think you should spend your time doing so. I think you should spend your time doing research. And that's what our next slide is about. And it's the final slide, is what are your expectations for a company? For understanding how much of this work does it take before you have a good stock pick? And this is probably one of the most controversial things that I say that I think a lot of my peers don't necessarily agree with, but I think I'm right. I think that with 1 hour, you can barely get any familiarity with the company, and that's what we did with Apple. We got 1 hour. 10 hours, you can have a slight familiarity with the company, a basic working model, a place to go to next. For 100 hours, you could have reasonable familiarity. You've listened to or met with the management of the company, hopefully several times. And I think after 1,000 hours of work, you can actually make a decision. Somewhere between 100 and 1,000 hours. You should never make a decision until you're very comfortable. And even if it's 1,000 hours and you're not comfortable, you shouldn't make that decision. If you're very comfortable at 300 hours, then so be it. But I don't think you can make a decision on an investment within 100 hours. I think it's basically not going to work. And sometimes you have 10 people helping you, and that can speed up the process. Sometimes you just have to be patient. Even if you put on your bets within half an hour, that doesn't mean that your approach works. My approach is my approach, and I just think that you shouldn't invest and risk funds without that kind of perspective. So we'll talk more about returns and long-term track records and things like that in a second. But that's sort of my perspective for investing. It takes a long time, and you have to think very carefully before you make the decision to invest. So if we have any questions, you're welcome to dial in and spend 5 minutes, maybe 7 minutes on questions. Hello? Hello?
Hey, how's it going?
What's your question?
Should I pick Annie or Brand mid?
Anyone else? Investing questions? We can just edit that out, so that's easy. You have to have your video camera working on, by the way. Otherwise, we won't accept you. We'll X you out.
Hey.
Hi, Alan.
Yeah. I was looking at the UWTI stock. It's in the ones, a little under 2. And if oil goes up...
I'm looking for questions on the lesson. So yeah, dialing in and asking about a random stock isn't going to really be useful. Hi.
Hi there, Martin. I was wondering, how much money does one need to have in order to make a successful investment?
I think you should spend less time about thinking about how much money you need and spend more time about getting your skill. And we covered this in the first lesson in pretty good detail.
Hey, I was wondering, how do you account, or do you account for any political changes that could occur? Say your company's based in Ireland or something, if you're expecting a revolution.
Yeah, so obviously the discount rate is a good way to do that.
All right, thanks.
Cool. We've talked about discount rates for 2 or 3 lessons in a row now, so it's hard to do that. All right, any other questions with people who have video cameras? It's a video chat website, so you have to video chat. We don't take non-video chats. If I can put my face on camera, so can you. Anyone else?
Hey, Martin.
Hi.
I got a question. We weren't really talking much about the dividend yields. Like, how would you factor that back into your model?
So dividends don't really matter. Whether net income is distributed to shareholders or kept in the company, it's still your net income. So I don't really think about dividends too carefully.
Okay.
The company is basically investing it, on your behalf in essence. Hi, Nick. Do you have a question?
Hey, how's it going, man?
Good.
I'm in my finance class. I will tune into your blabs later. I've been looking forward to them.
Okay.
See you, Martin.
Bye.
Hi, can you see me now?
Yes. How are you?
Good. Basically, I was looking back, I think it was like last year. Noticed that you have quite a bit of influence on how markets move, like simply by just putting out tweets or certain information. I think the company was like CYXX or something like that. And you actually had caused it to like crash within, an hour or two based off of just some information that you put out. So how can I be more like you and manipulate markets just by the word of my mouth?
Well, I think that if you become a really successful investor and learn a lot about finance, you can certainly your comments can influence the markets, but I wouldn't call it manipulating. I mean, if someone thinks a movie is a good movie, more people will go see that movie, like Siskel and Ebert, right? I don't know if you remember those folks. You have to have a good track record of predicting stock movements. Thanks for the question. PMW?
Thanks, Martin, for giving that lecture. For someone who doesn't have a background in finance, I find it's actually quite useful to hear about it from you. I just wanted to talk about or ask a question. Does your basic spreadsheet cover both eventualities for companies offering services, or would the approach for companies offering services differ from companies selling goods?
Yeah, it's a good question. I think every company is different. We can model product companies, services companies. There's companies that do neither. There's all walks of assets out there. Think about real estate, right? It's kind of not a good or a service. So there's a lot of ways to model. We obviously did Apple the way we did it for a specific reason. I have a few more questions. My dinner date is getting a little antsy.
Martin, is inflation accounted for in the discount rate?
Usually, yeah. That's why there's a 2% discount rate on the government bonds. So there's a security called the TIPS, which is the Treasury Inflation Protected Security. And the TIPS is basically a way for us to take out inflation. Let's see if there's a good way to pull it up on Bloomberg. I'm not an expert on this. The TIPS is a good way for us to strip out inflation. Sometimes call them strips, in fact. Here we go. And a Treasury, the TIPS for 10-year bonds yield 0.3%. And the 10-year bond yields 1.8%. So it's telling you that the inflation expectation is 1.5%. So any discount rate is going to include a baseline of inflation. Now, there are discount rates that have negative, there's deflation out there. So certain countries that have that. In fact, in the U.S., we expected potential deflation. Sorry, I'm just texting this young lady. So in any event, in general, you should be including discount rates. You should be including discount rates. Hilarious. Let's see here. I'm a computer expert. Should be able to remove this. I think it's funny. I don't mind. All right, that wasn't too hard. Oh well, looks like it's over. Maybe I'm on the wrong one. I'm on the wrong one.
Cash that they just have stashed, why do they still have debt? Why don't they just pay it off?
That was fun. Can you hear me?
Yeah, we can hear you, buddy.
Hello?
Hello?
I got ruined. I didn't even suspect it. I don't know why.
Hello?
Martin, I have a question. If Apple has all that cash stashed with them, why do they still have debt? Why don't they pay it off?
Hey, sorry, I'm back now. You have a question?
Yeah, I have a question. If Apple has all that cash with them just stashed away, why don't they pay away their debt? Why do they just keep the debt with them?
It's actually a great question. One of the reasons, so just think about it from your own perspective. Let's say you had cheap debt, right? You could borrow, how old are you? 20s, 30s? 10?
22.
Teens? Okay, 20s. If you could borrow $10 million, if I lent you $10 million with 1% interest right now, would you take it?
Sure, yeah.
Yeah, it's a very low interest, right?
Right.
And even if you had $20 million in your bank account, would you take it? You should. Because what if you wanted to buy something for $25 million? Right? You're rich, you have $20 million, but you don't have 25.
Right.
So you'd like to be able to have another 10. So you have 30 in cash with 10 in debt, even though you have 20 in net cash. But that extra flexibility allows you to, say, buy something for $25 million. If you could buy something for $25 million that's worth $500 million, right? You would make a huge amount of money. You make $475 million. And opportunities like that may come up from time to time, and the last thing you want is to not have that extra $5 million that you need, right? So what if the market crashed tomorrow, and Apple could buy Tesla, they could buy SpaceX, and they could buy Netflix, for $200 billion. They would do it. That's why that extra debt comes in handy. Does that make sense?
Yeah.
Cool. Thanks for your time. Seamus, you have a question?
I'm just playing League.
I'm banning you, dude. Anytime you come in here, we're gonna ban you.
Hi.
Hi.
Yes, calling from Puerto Rico here.
We have kind of have a shirt policy that we tend to try to keep. But go on.
I'm sorry. No, I just have a quick question. I'm a huge finance geek, and the thing is that I realized that my mother actually has like $36,000 sitting, and she doesn't know anything about finance.
You have to. So if you call in and have a question about the 1.5 hour lesson that I just painfully put together, it would be very nice.
Can you link the Bloomberg website you were using?
Bloomberg software is you have to have a license to it. It's expensive.
Oh, okay. Thanks anyways.
No problem. Hi, Bob.
Hi, is there a link anywhere to the beginning of the financial lessons so I can like watch them in order?
Yeah, they're on my YouTube website. I don't think it's too hard to find.
Okay, thank you very much.
Sure, no problem. Thanks for calling.
Just go to Martin's stream and then click his YouTube link, and then it should pop up when he ends the recording and uploads it.
Martin, are you familiar with the Valiant Pharma?
Valiant Pharmaceuticals, yeah.
Yeah. So yesterday it was at.
Is this a question about the lesson that I just prepared?
Sir, I was not. I just got home, so.
Okay. So we just take questions on the 1.5 hour lesson, so we can make sure that the questions are related to the material. It's hard for me to answer off-topic questions. Hi.
When you were in that Bloomberg application, you were looking at the Apple investors.
Yeah.
If those top 2 or 3 investors were to get out, or if one of them were to sell, what would happen to the stock?
It probably wouldn't. It probably wouldn't change. I think that there's always a buyer in a market.
Yeah, that's what I never really understood. Because if you're selling stocks, there's always someone else buying them. So if big investors sell everything.
Well, I mean, if they're big enough, then sure. If Bill Gates sold all of his Microsoft stock, it would leave a mark. But eventually, the stock market would correct itself.
Okay.
Thanks for asking, dude. It's a good question. Yeah, try to stay on topic, specifically to the lesson. We can always talk stocks and stuff some other time, but the lessons are recorded.
So my question is regarding the lesson, but it's more so an investing question. So when you look at Apple's balance sheet, you obviously see a lot of cash there. So, I mean, when you're looking at the market conditions today, and since you're probably one of the kings of M&A, why wouldn't they be purchasing companies that are within their realm, in terms of tax inversions and
That's a great
getting
question. Yeah, one of the problems with M&A is integration. You actually have to run these companies after you buy them, and that ends up being harder than it looks. There are a lot of companies that tried that, like Hewlett-Packard is a good example. They did a lot of M&A, none of it worked, because you have to mesh these cultures, and it's just so difficult. Google is trying this kind of umbrella approach as well. It's just very difficult sometimes to run these companies as part of your own company. But I will say that I'd be shocked if Apple didn't make an acquisition at some point. The other thing is a lot of these big tech companies, they don't want to sell. So Netflix is probably the only company that probably would sell. But companies like Tesla and others, it's very hard to get a friendly merger. One of the reasons I like M&A is I like to do hostile M&A. So I like to really pressure other companies with using especially psychological torture.
Well, what about Apple buying a Fitbit? Maybe maybe not as large as a company as Tesla.
They have to make the call. I mean, look, they bought Beats, right? They bought Beats, and they also. I mean, you have to ask Apple. A lot of people have asked them that question. Why haven't you done any deals?
Is investor relations going to give me a good answer on that one, or
that's up to you. Sometimes a lot of people invest based on how nice the company is to you. It's not a good reason to make any investment. But you got to think it through. It's a fundamentally important question, and we'll touch on that in other lessons. Is how do companies use their cash to make investments on behalf of their shareholders? And Apple, they've been using their cash to buy back their own stock, which is doing something. So they're not just sitting there, doing nothing with it. And they bought a few companies. They bought Beats. They bought, But I absolutely agree. They should be doing. They could and should do something. I think. But
do you think in today's market, in the volatility that's going on today, I feel like it's just too expensive for a company to be investing into other securities. So,
a company that's not their expertise either, right? So they can't.
Yeah, of course.
Tim Cook doesn't know how to invest. But if he sees an opportunity to acquire another company, it's just so hard because all these deals have to be done in a friendly way. They have to actually, sit down and hammer out an agreement. And these tech companies are so arrogant. That's why you never see tech mergers. You see pharmaceutical mergers every day. But in tech, they always think they're going to be the next big thing. And Yahoo's for sale. So we'll see if Apple buys Yahoo. I doubt it. Again, one of the big things that happens in tech is the egos are so big that the tech companies never think that the company. They always think that every other company is beneath them. So, for Tesla, I think Apple said, we can make our own cars. We don't need to buy Tesla. And maybe it's true. So in any event, it's it's a great question. Let me see if I can grab another couple of questions before my date gets here. She's going to kill me.
So, obviously, when you were looking at biotech stocks, the most important thing was looking at the drugs and how it was going to impact people and whether they'd be successful. So do you think with tech stocks, the most important thing is actually the tech, or with something like Apple where it's kind of too big to fail at this point, like how do you really consider if it's going to grow?
Yeah, I mean, forecasting is forecasting. I think, some of it you can see into the future. Some of it's trust and management and the direction they're going to take it. Some of it is what they say. If another example is, what if they put out a new product and it flops? Apple's flopped a few times. Apple TV, Apple Watch. iWatch was pretty fucking stupid, and it flopped pretty hard. So why should we trust Apple to release something more complicated, like an iCar? My guess is, so that's my forecast. Your forecast could be, they flopped in the past too, and then they put out iPod. So, it's everyone's guess is you have to make a reasonable assertion. What the stock market gives you, that's sort of the secret, and we'll talk about in Chapter 4 and Chapter 5. The stock market often will give you an opportunity to make a bet that is very likely to be in your favor, heavily in your odds. And if Apple stock goes low enough, the stock price is implying that the company will decline. And right now, Apple stock price is implying that they can't stay at this peak for this long. And that's, who knows if it's true or not. But the point is, if the expectations are really, really low, those are often investments you want to make. So in any event, we'll talk about that more in detail.
Question.
Hey, Alex.
Hey, how are you?
Excellent.
I've heard a lot of money managers, Buffett included, talk about the difficulties of running a fund when they have like exorbitant amounts of assets. Can you just elaborate on why some capital managers think it's hard to find opportunities when they have a lot of money to invest?
It's a better question for our next lesson because we didn't touch on portfolios or anything now. But certainly the more capital you have, the more difficult it is to make investments in small companies. The bigger the company, the more likely the stock price is going to be arbitrageable. The bigger the company, the harder it is to see an arbitrage. The smaller the company, the more likely it is to be misvalued. But if it's a $100 million company or a $1 billion company that's misvalued and you're running $500 billion, it's a little hard to make an investment in a $1 billion company. You basically have to buy the whole company. And even then, it's not material. So that's more or less the reason. Hey, Chris.
Hey, sorry to bother you again.
No problem.
So, would you, since this is a introduction to finance class for everyone here, it's hard to pick stocks, and like you said, you might be 30% off either way. Would you just suggest indexing for, your everyday retail investor? Because
good question.
It seems like
I actually don't think stocks go up over a long period of time. So I don't think indexing makes any sense because I think stock markets don't go up over long periods of time. But we can talk about that later.
That's funny you say that because I have a graph from the Center of Research and Security Prices from the University of Chicago, and it clearly it's called the big picture. It clearly shows that U.S. stocks since 1926 has been the best.
But why 1926?
I guess that's closer to the inception of the stock market. But on
average, I don't think that's true.
You don't think so?
There have been stocks since the 1700s. There's a lot of that data. I've thought about this. Hold on. I've thought about this concept a little bit, right? I've traded probably $1 trillion of stocks, and it's not that clear to me that stocks go up over the long term. I think that I've seen all the same graphs. They're not inflation adjusted, right?
Well, no, it actually shows inflation below the U.S. So from 1926, inflation has grown to $16 if you invested $1.
And how about the composition of the indices? That's often a tricky.
That's a great question.
There's sort of survivorship bias in there.
Yeah, I guess they're going for blue chips,
Well, even with blue chips, I think there's survivorship bias because what they do is the indices they just replace the losers. So there's a lot of kind of questions about how I'm not really sure stocks go up over the long run, and if they have gone up, even if it's over 80 years, it doesn't mean that they're going to retrace now to a central tendency. So I think there has been a lot of inflation of asset prices, and I'm not certain that we should readily accept that prices go up all the time. It's absurd. Prices go up all the time in real estate and stocks. And what the fuck? Like, that it doesn't make systematic sense that asset prices should have a general tendency to appreciate, especially when GDP doesn't appreciate.
I agree, but so then how do you base asset prices? I mean, PDE,
Cash flow, discounted cash flow.
Okay, that makes sense. Good point.
Yeah, but I love that kind of theoretical question, and just because I have a different opinion doesn't mean I'm right. You could be totally right, Chris. But next time, over the next several lessons, we're going to flesh this out more further, and I'd love for you to come back and really kind of discuss that, because it's a really, really, really good question, and something I've struggled with for over maybe even 2 decades on a theoretical basis.
Absolutely.
So thank you.
Thank you.
Hey,
I think Phoebe was ahead of you. Sorry.
Okay, thanks. Question about quality of cash flow. Do you factor in the quality of cash flow from, say, something like recurring revenue from like an iTunes from Apple versus something that requires a lot more, say, intensive R&D product? Is that reflected in the overall discount rate of how you value it, or is there kind of a more specific valuation? Because those cash flows, I would imagine, aren't to be considered.
It's a great question. It's a fantastic question. So, like, someone was asking me yesterday, what discount rate do I use for pharmaceuticals? The funny thing about pharmaceuticals is that you take them every day. Like, I've taken this drug for 20 years. It's called Claritin. I wouldn't say I can't live without it, but once you're a customer in pharma, you're basically a customer forever. You don't stop. But I've changed phone companies willy-nilly. So the thing about, like, there are definitely stickier assets that are just going to kind of live there and breathe there. And Apple's composition right now, I'm not certain we'll do this next lesson, but it's very heavily weighted towards selling hardware, and hardware is very finicky. I followed tech on and off for 15 years. Hardware is a little more finicky than software.
So you would probably apply a different value or quality valuation to that than the recurring revenue of an iTunes or an App Store.
And when you say quality of cash, typically when people say like quality of revenue or quality of cash flow, they're really dealing with like forensic accounting more than this is like the term quality, especially in finance, has a very specific meaning. So I would avoid that. I would just call like I mean, it's certainly an appropriate word. Don't get me wrong, but you know, like robustness or like recurring revenue is often what people say. Anyway, great question though. Really awesome question. Hey, Hunter.
All right, thank you.
No, hey, I just want to say thanks for putting this on. It was extremely informative. I learned a lot. And what was the name of the book you recommended?
It's
so
called
maybe someone wants to read about investing.
It's called Common Stocks and Uncommon Profits by Phil Fisher.
All right, thanks. And what are some other books you'd recommend for?
It's in the PowerPoint. There's a bunch of them. Margin of Safety is probably the best one. Hey, Imran. Hey. I think your mic's off. You can try dialing in again later when your mic works. Hey, Hyun. Okay. He can just dial back in. Oh, I think I had muted him. Just dial back in. That's fine, dude.
Hey, Martin.
Hi.
I have a question. When you make investment in a company, do you consider a thing called PE ratio, which is price-earnings ratio? I'll explain. Back to Apple, for instance, but that ratio, they are dramatically undervalued.
So PE is...
So, I mean, theoretically, if you invest now...
So PE is just sort of... we'll talk about PE next lesson. I don't think it's that important. I think it's just a shortcut for discounted cash flow, and you should focus on cash flow. Hey, dude, sorry to cut you off.
I wanted to ask was basically bonds are sort of more secure than stocks.
Yes,
are they?
Definitely.
They are more secure, but
typically
you would have much less sort of return.
Sometimes.
Compared to stock.
That relationship is very complicated.
Okay, all right. So let's say for example, for youngsters who have a lot of time in front of them, they want to sort of take a bit of...
Yeah, we're not going to talk about kind of what investments you should make in any given point. The only thing we're focused on right now is just analyzing individual securities and trying to understand them before making any investments. Hi.
So when Apple hires software developers, is that part of the cost of goods sold or part of research and development?
Great question. I love that you asked this question. Accounting is pretty boring and difficult. It depends. So if it's a software developer for a new project, like an iCar or something, it would go into R&D. If it's a software developer that is putting an ad out for an Apple, let's say, website, that goes into SG&A, or selling general administrative. If it's a software developer that's working on their accounting system internally, again, SG&A. If it's a software developer for the iPhone itself, it could either go in R&D or cost of goods sold. It kind of depends. It's a good and tricky question. Definitely a tricky question.
Depends on what?
It sort of depends on what they're doing exactly, and whether the financial team thinks that person's work is part of the product. And it typically would not be. It would typically just go into R&D. But I could see on occasion that those developers would be a part of the iPhone. I mean, if it's not inside it, or it's not someone who put it inside it physically, it's hard to call it cost of goods sold.
What about like the iOS? Like,
yeah, but
people develop.
Exactly. That is technically sort of in there, and it had to be made by somebody. So it does make sense that it could be a cost of goods sold.
Okay.
It's not worth, kind of twisting your mind around too much on it, but definitely software expense counts in cost of goods sold. I mean, it has to, right? But most, I would say 90% of Apple's cost of goods sold is going to be iPhone parts, glass, metal, transistors, chipsets, stuff like that.
Right.
So, great question, though. Hey, Dean.
Hey, Martin. I have no question. Just wanted to say hi.
Cool. Hi.
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 Hello.
Yeah, you alright? Yeah,
I'm good.
I was just gonna say about like stock markets and stuff. What would you recommend? So if I wanted to put some money in stock market,
So only want to ask questions about the lesson, and we're not ready to make investments. We're just studying investing itself. Hi, Art.
For one of the next lessons, could you?
Quick question. What software do you prefer to use for charting? I'm so sorry, I didn't mean to cut him off.
Oh, it's okay. I don't really look at too many charts. I use Yahoo Finance or Bloomberg. Hi, Al.
Hey, so could you dedicate a few hours or an hour next session to day trading, or maybe the entire day to just day trading with like $10,000 or $50,000?
No.
I think that'd be really fun, and people would learn a lot.
Nope. My lesson plan is set for the next year. Sorry, dude. It is called gambling, I would agree.
Oh yeah, dude, day trading is a good way to lose a lot of money, especially if you don't know what you're doing.
Yeah.
Yeah, I do long-term investments, but biotech, man, as soon as they started going after you on the news, everything took a shit. And so, when do you think it's a good time to get back? I know, it almost seemed coordinated.
It seems like a Steve Urkel moment. Did I do that?
Yeah, I know, everything. I was like, oh shit, I'm down 10% on pretty much everything. I caught out quick. But when do you think,
Did I crash the stock market? My bad.
I know, man. That would have been a good short. But so when do you think is a good time to a good safe time to get back into biotech? And do you think the presidential elections are really going to affect it?
I mean, that's a good psychological trading question. I don't know. I just buy stuff at deep value. When I make investments, I try to make 10, 20, 50 times my money. I'm not going to front.
So value-based trades.
Yeah.
When you do your research on the company, I mean, obviously you have a lot more insight than your average Joe as to what's going on behind the scenes, but how do you get past the marketing nonsense and into really what's going on?
I think, with experience, you kind of get a good bullshit detector, with
Okay, all right. Thank you, man.
Experience. Anyway, that should be it for today. So I'll see you guys tomorrow, hopefully with a new lesson. If not, I'll just be around to chat some more. So stick around if you want. I'm going to open it up